Is Tesla the new meme stock? One major investor says it's behaving that way. I'm Lisa Bernhard with Reuters, and joining me today is Ross Mayfield of Baird. Ross, longtime investor and bond king Bill Gross, the co-founder of Pimco, posted on X, of course, Elon Musk's platform, quote, Tesla acting like a meme stock, sagging fundamentals, straight up price action. The stock's up again today. Do you agree with that sentiment?
Well, I think that stock has always had a pretty fervent fan base of retail investors, in particular. And so, a lot of times those kind of stocks can be driven a lot more by sentiment or, a headline than what's going on underneath the hood. I do think it's speaks a bit more to the moment, right? Where retail investors are taking a bigger share of the pie. You see things like short-term options and retail volume ticking up. So whether it is or isn't, and speaking to the fundamentals is not really something that I'll do, but any of these stocks that have big retail fan bases are liable for moves like this. And I think as we head forward, this will be more likely, both with smaller cap pure meme stocks and even with large cap stocks that develop fervent fan bases.
Okay, so despite not speaking to the fundamentals, I will still ask you, though, it's been up for 10 sessions. Do you see the stock pushing higher?
Well, alongside a lot of the other kind of mega cap growth stocks, it's really been all that's worked in the market of late. And so I think there's a lot of momentum behind this kind of trade, whether it's the individual names or the kind of big tech Mag 7 conglomerate altogether. So there's momentum there. I think to the health of the overall market, it maybe says something that things are weakening a bit and the economy is cooling, but there is a lot of momentum there. There is still a lot of dollars chasing the AI theme, which all those stocks, to the extent they're actually involved, are all associated with. And so I do think there's still some legs to that run as we kind of trade through low volume summer months here.
Well, let's pick up on that point exactly, because we're seeing these streaks of record highs with the S&P 500 and the NASDAQ, and they're really being pushed higher by those stocks, right? And NVIDIA leading the way. And the gap in returns between the S&P 500 and the index's equal weighted counterpart is at its widest in 15 years. Are we getting into territory that is really too risky? That if something turns with these AI stocks, it's a house of cards and it all falls down?
I think it's a great question. I would say two things. I think the first thing is, these stocks are primarily pretty strong on a fundamental level, right? The earnings under the hood, the cash flow under the hood are there. A narrow market historically hasn't portended weak returns going forward. More often than not, you actually see the rest of the stocks kind of catch up and breadth expand. So it's not necessarily a big harbinger of weakness for us. Now, that said, for an individual investor, I do think you need to question whether, owning the S&P 500 or owning the NASDAQ is the level of diversification that it might have been sold as, when you have such a big concentration in a handful of stocks that are all very levered to one theme that is still pretty new. I do think it opens the door to the question of whether that is truly a diversified position or whether you need to add something like an S&P equal weight, a value index, a small cap index, something to kind of barbell against that mega cap tech concentration.
Okay, let's change gears and talk about Fed Chair Jerome Powell. Day two of his testimony today in front of the House yesterday was the Senate Banking Committee. What jumped out at you? What struck you about what he said?
Well, he's very good at trying not to surprise the markets at this point. I think the thing that jumps out at me is even the slightest acknowledgement of the two-sided risk of the labor market versus inflation, right? At this point, we've seen unemployment tick up. Headline payroll growth has been fine, but initial claims are higher than they have been. All of the JOLTS data points to a cooler labor market. So you want to see signs that the Fed is at least acknowledging, if not explicitly, starting to cut rates tomorrow, that the labor market weakness is something they're concerned about, that it's no longer a major pressure on inflation, which I don't think it is. And it opens the door to not just September, but additional rate cuts later this year and early next year, which at this point, the market, needs to see. I think the economy is cooling underneath our feet, and the labor market, which has propped up consumer spending for a couple of years, is starting to wobble. So an acknowledgement of that has been great to see.